So hello everyone and welcome to the Public Podcast. I'm your host, Kyla Scanlon. We are here with you today to discuss regulation in the financial sector after the recent banking crisis. Don't forget to like, comment, and subscribe to our YouTube channel for more in-depth interviews that will help keep your portfolio on track. Today we're here with Sheila Bair, former chair of the FDIC from 2006 to 2011, managing over 300 bank failures, and is now senior advisor to the Center of Financial Stability. And we are going to talk about the banking sector today. Sheila, welcome to Public, and thanks so much for doing this.
Yeah, thanks for having me.
Of course. So to start off, the FDIC, the Federal Deposit Insurance Corporation, and the Fed have been in the spotlight during the recent banking crisis, as we all know. So if we can zoom out to the big picture, what is the role of the FDIC in guiding banking regulation in the United States compared to that of the Fed?
Right, it's a good question. So the FDIC insures all bank deposits up to the caps of $250,000. So that's true for every bank. And then it is one of three federal bank regulators who also have supervisory responsibilities. So the FDIC and the other regulators have examiners that go into these banks, interview them, look at their books and records, look at their loans, look at their stability. And the FDIC is the primary federal regulator for several thousand of state chartered banks, which also have deposit insurance. So we have what we call a dual charter system. So there's a national charter, and if you have a national charter, a federal charter, if you're a bank, you're regulated by the Office of the Comptroller of the Currency. If you're a state charter, but you're not a member of the Federal Reserve System, then you are regulated by the FDIC in partnership with the state regulator that chartered you. If you're a member of the Fed system, then the Fed is your primary regulator, again, in partnership with the state regulator. So it's confusing, I know, to people. I wish we had a simpler bank regulatory structure. Yeah. But in any event, so those three regulators, though, the Fed, the FDIC, and the OCC, work together on rules that apply to all banks, and including really important bank capital and liquidity requirements. And then the Fed also is a holding company regulator. So if you're an insured bank, but you are owned by a holding company organization, then the Fed has oversight over that holding company piece. And most of the larger banks, almost all, certainly the mega ones, the $1 trillion ones, they all have holding companies. And so the Fed has a lot of influence at the holding company level over the entire banking system.
Wow. Very complicated indeed.
Yeah, too complicated, to be honest with you. Aren't you sorry you asked?
No, it's all very interesting. And the thing is, it's so important to understand it. And I know that, the duties and responsibilities of the FDIC have sort of adapted since the 2008 banking crisis when you were head of the FDIC. So how do those duties and responsibilities look like now relative to when you were there? Yeah.
Well, it's a good point, because unlike the other bank regulators, the FDIC is also a deposit insurance. It's an insurance company. It insures deposits at these federally regulated banks up to $250,000. There are ways to get more than that through account restructuring. Until everybody, your household out there, you don't want to mess around with monitoring the health of banks, stay below the insured deposit limits. You can go to the FDIC's website if you want. If you have, most of us don't have more than $250,000 to put in a bank, but if you do, there are ways to get more, and you can find the information on the FDIC's website. But the deposit insurance rule is also a very important rule. The FDIC charges premiums for banks. The FDIC's reserves are pre-funded by premiums that are charged of all banks. Those are risk adjusted. So if you are a bank that the FDIC views as riskier, you may have to pay more in premiums. Or if you have a not a great supervisory rating from your primary regulator, you may have to pay more in premiums. So that also, in addition to regulation, the deposit insurance premiums can impact bank behavior a bit. And then, of course, if a bank fails, and this is what's been in the headlines lately, if a bank fails, the FDIC comes in immediately and takes control to make sure insured depositors are protected. It's been doing that for nearly 90 years. Got a perfect record. Nobody who ever had an insured deposit ever lost a penny of those insured deposits. Sometimes also the FDIC can find an acquirer for a failed bank who's also willing to cover the uninsured. And that's what happened recently with the First Republic failure, which was sold to JP Morgan Chase. Other times there will not be a buyer for the uninsured, and then uninsured depositors can take losses. The government used an extraordinary procedure called the systemic risk determination for Signature Bank and Silicon Valley Bank. I'm sure your viewers have heard about those failures. That was a pretty extraordinary thing to do, but they did step in and protect all the uninsured at those two banks, which were heavily reliant on uninsured deposits to fund themselves, which is also quite unusual.
Mm. Yeah, and I think the other reason too is like it was just dominoes tipping. Like if they didn't step in, things could have gotten so much worse across the whole.
That was that was the argument. That was the argument. I kind of think that we had that anyway. I mean, I can argue both ways. I can say you made this dramatic systemic risk determination, kind of telling everybody you thought it was systemic, where banks fail. We had actually close to, I think, 365, 370 or something like that when I was there at the FDIC. So banks fail. The FDIC protects insured depositors. Uninsured may or may not be protected depending on bidding interest. But I do think I can argue that both ways. And actually, I was disappointed that they used the systemic risk determination because it's not, it's not, I didn't think that was, oh my gosh, sorry, I thought I turned all these off.
No, it's okay.
Your other guests before, my apologies to everybody watching.
No, it's okay.
Anyway, I think if they thought there was a problem across the system with uninsured deposits, they could have gone to Congress. There's a special fast track procedure to approve some special programs in that instance. Those are the kinds of programs we used during the Great Financial Crisis. They did not do that. So these two banks, the uninsured depositors, kind of got a special deal. I think there's confusion now about what's protected and what isn't, which bothers me. And I still continue to tell people, if you're a household, stay below the insured deposit limits. If you're not a sophisticated person who can look at bank call reports and financial statements, and there's a lot of good information out there, but if you're not, most households don't have the ability to do that, so they should really stay below the insured deposit limits.
And so what was so disappointing to you about it? Was it just that they invoked this thing like that they shouldn't have invoked, or was it the overall action? Like, did they move too fast, too slowly? Like, how did you think about it?
Well, I thought first of all, they didn't show their work, so I really haven't seen, it wasn't clear to me why they thought banks fail. I mean, that happens, and uninsured depositors sometimes take losses. That's the way the system works. And to kind of break those rules, really make special exceptions for two banks. And so most of those uninsured depositors were quite wealthy people, very large corporations. So I think the optics around it were terrible. Dodd-Frank was supposed to prevent that kind of one-off bailout. The paradigm going forward was that if there's a true system problem, then go in and provide backstops for everybody. Don't say, okay, well, Silicon Valley Bank's going to get it with their billionaire venture capitalists. But, my little community bank, my $2 billion community bank, if it fails, sorry, if you're uninsured, you're probably not going to get help. So I think that's a really bad situation to be in. Help everybody, or, just apply the rules to everybody, whether you're a billionaire, or whether you're a $100 billion institution, or whether you're, a $500 million institution. The same rules should apply. So yeah, I do think that was the wrong way to approach it. I think with good communications, I think they should have gone, if they really worried about uninsured runs, they should have gone to the Hill for that fast track approval. It was done during the pandemic. Fortunately, the FDIC didn't have to use it, but Congress gave the FDIC the authority to reinstate the program, again, which we used during the Great Financial Crisis if needed. I think they could have done that if they did it early and did it on a nonpartisan basis. They decided not to do that. Even failing that, no pun intended, with Silicon Valley at least, I think there were good assets in both of these banks, especially Silicon Valley. So the uninsured depositors would have had substantial recoveries. What we're seeing now is probably, if they had actually imposed losses on the uninsured depositors, they probably would have taken about a 10% loss. So the FDIC could have very quickly paid an advance dividend to those uninsured depositors. They would have had access to most of their money. But the rest of it, those uninsured depositors at 10%, they would have borne the loss, about $13 billion total between Silicon Valley and Signature. Now, there is an assessment that's applying to banks more generally, that is going to be passed on to bank customers. So I do disagree with it. These are tough decisions. I sympathize with them, but I don't think that was the right approach. That's not what the systemic risk exception is supposed to be about.
And I think there's also, I don't know if anger is the right word, but some frustration with the Fed too. And people are like, oh, the Fed should have done a tighter stress test on these banks,
Yeah.
And caught all of this before they collapse.
Yeah. No, that's true. There were some supervisory lapses. They were poorly managed banks, so the primary responsibility rests with management. But yeah, the supervisory process could have been better. It could have been better. And, these both Signature and Silicon Valley, huge rapid growth. So that's a huge red flag for any time. During a great financial crisis, any period of banking stress, when banks fail, rapid growth is so frequently a common factor, and a high reliance on unstable deposits. In this case, really a lot of uninsured that at the end of the day didn't have much loyalty to the bank, as the bank discovered. So yeah, those things could have been caught earlier. The stress test might have helped a little bit. I don't think they would have. I've seen the analysis. There have been arguments on both sides. I don't think imposing these stress tests that larger institutions have, I don't think that would have caught all the problems. I think these banks would have failed anyway. But the losses would have been less because they would have had more capital at least. Probably not enough to keep them afloat, but the losses to the FDIC would have been smaller.
Mm-hmm. And I think also too, like with the stress test and just the banking crisis in general, and your point of like maybe mismanagement by the banks, a lot of the losses were in the banks were due to these HTM securities,
That's right.
So held to maturity securities, whereas like they were just maybe not using accounting the way that it should have been used.
Yeah.
And so for you, like, are there any similarities to that where these banks were, sort of mismanaged to the 2008 crisis that you were a part of? Like,
Right.
And if not, what are the differences there?
Yeah. Well, you're right. Unrealized losses were a big factor with recent failures. And again, so the U.S. has weaker rules around when you have to, even though you've not realized the losses, you have market losses on your books, you're carrying unrealized losses on your books. When you have to deduct those losses from capital, have that reflected in your capital base. In the U.S., only banks above 750 billion have to do that, whereas in Europe, almost all banks have to do that. So, and you look at European banks, they actually have a much lower level of unrealized losses. I think one of the reasons is because they do have to reflect it on, they have to deduct it from capital. And then also their liquidity rules, they don't really get credit for anything longer than 5 years. So a security in a rising interest rate environment, you've got a low yielding security on your books, right? And the longer the maturity is, the bigger the unrealized losses are going to be, because it's going to be many years before you can redeem it at par value when it matures. So those are two things they do in Europe, I think, that we could do better here. That's absolutely a very good point. And the hold to maturity portfolio, on the other hand, all banks, and this is true in Europe and the US, all banks of any size, if you have securities and hold to maturity, which means you have both the ability and the intent to hold them to maturity, you do not have to mark those against capital, because you will not realize losses if you truly do hold them to maturity. You're going to have a low yielding asset on your books, so that's going to hurt your earnings, right?
Sure.
But you're still not going to have a loss if you can redeem at par, you can hold to maturity. So that is a feature with all banks. And it's done so that you don't have a lot of volatility in your capital, because, mind you, when interest rates are going down, the value of those assets is going up, and then you could mark really big gains in your capital too, which might not be truly reflective of your capital strength. So that's a harder challenge. But I do think auditors and examiners need to be really closely scrutinizing whether the securities in those HTM portfolios, they really do have the ability to hold them to maturity. And a bank like Silicon Valley, over 90% reliance on uninsured, they didn't have the ability, and the auditors and supervisors should have caught that earlier.
Yeah, absolutely. It was just like it was so many points of failure across the board. It
There
seems
were.
like,
It was.
like
Yeah. I agree with you, and I still think people ask me about that a lot, and it concerns me too. But I do think these are aberrational. I do think supervision is much stronger now than it certainly was during the Great Financial Crisis. Bank management's better. Bank capital levels are better. I do think these banks were outliers. And we're seeing that now because
mm,
the system's really, and I said that all along, the vast majority of these banks are fine, which is another reason why I thought the systemic risk thing was an overreaction, because the vast majority of the banks are fine. And you see things are calming down now.
yeah, yeah. And how so like with JP Morgan buying First Republic or taking
Right.
over those deposits, we are seeing big banks getting really, really big. Like,
Yeah.
do you worry about that at all? The
Yeah.
concentration?
Well, I do. The FDIC has something called the least cost test. So if a bank's approved by its primary regulator to bid, which JP Morgan Chase was, the best bid, the FDIC has to go with the least cost, the best price. The best price is offered for that failed bank. So
That's right.
I know the FDIC has been criticized a bit for that. We also, when I was there, WAMU was a bank, a thrift that failed.
Hmm.
And it was also sold to JP Morgan Chase, which by far was the best bidder of all. We couldn't get many banks to bid on it. It was a pretty troubled bank, and thank goodness JP Morgan Chase, looking back on the time, did, because if we'd had to liquidate it, the losses would have been catastrophic. So I think if you don't allow these big banks to bid on failed banks, then again, the trade-off will be it's going to cost the FDIC a lot of money. So there's that.
Hmm.
One thing, though, I think government can and should do to prevent this increasing concentration, which always happens during financial turmoil, is to help stabilize uninsured deposits, at least those, not all of them, but those that are what's called transaction accounts. These are operational accounts, checking accounts, if you will, for businesses, nonprofits, local governments. That's where their money that's coming in, they put it in there. The money they're spending goes out, the payroll, the expenses, what have you. The tax revenue comes in before it gets dispersed here and there. You got a big multi-million-dollar grant coming in if you're a nonprofit, that goes through your account temporarily before you put it in your investment portfolio. So even for smaller organizations, these kinds of accounts are almost always uninsured, or frequently fluctuate above the insured caps. But they're really important to the real economy. And you don't want to, when a bank fails, for people not to get paid or what have you, because it's an uninsured, frozen up in an uninsured account with a failed bank. That is a bad problem. And so what you're seeing now is these transaction accounts, because they're so important to the depositors, they cannot risk losing access to their transaction accounts. So you're already seeing that move to the too big to fail banks. Either that, or they're setting up backup accounts so they can move very quickly if they can. This person will not stop calling me.
Oh
So
my goodness, it
anyway,
must be an important call.
I turned it off, but it still shows up on my phone. I cannot figure out on my
Oh
watch how to turn it
gosh.
off. So apologies to your viewers.
No, it's
Any
all
tech
good.
people can feel free to let me know how to do that.
Yeah.
But anyway, so I think you could. We provided unlimited coverage temporarily for those types of accounts. I think Congress has to do it now. They should do it again, because deposits are going to these too big to fail banks, and that's very problematic for the regional and smaller banks.
Yeah, exactly. Which is it's just interesting to watch because like then there's other points of failure with those too. Like commercial real estate is now a
Yeah,
flashing
that's
red
right.
bell for other reasons. So like there's all these tipping dominoes.
Yeah, no, that's right. Well, I think commercial real
Yeah,
estate is, some of it, like it's a big category. So multifamily
huge.
financing, that's strong. We
Hmm.
need more. We need more multifamily housing. It's
Yes.
really the office and the urban retail where you're seeing
Yeah.
really high vacancy rates. And yeah, but I think that will probably cause some more bank failures. I think we can expect more bank failures. I think it'll be slow. It'll be gradual over the next
Mm.
few years, but people should not be surprised by that. Banks do fail. That's just part of the system, and it's not necessarily a bad thing, so long as households stay below those insured deposit limits. I don't want Main Street America losing losses on their deposits, which is why we have pretty high coverage levels to begin with. But yeah, CRA will be a factor if we have a recession with the Fed raising rates. If
Mm.
we have a recession, that could also, then you're going to see a lot of credit losses, not just on commercial real estate, but other types of business borrowing and consumer borrowing. So hopefully the Fed will have a soft landing. We won't have a severe recession, but that could also cause a lot more bank failures.
Yeah, absolutely. Just the stress that comes with that, and
Right.
trying to manage an economic downturn is hard for sure.
Yes, it is. Yep.
Yeah. So this will be the final question, but I do want to finish off the conversation to take a moment to talk about your path of being a children's book author.
Okay.
And you've written a variety of books under the title Money Tales.
Right.
So can you explain what drew you towards writing children's books?
Yeah.
And what do these stories mean to you? And what do you try to achieve with them?
Yeah, well, thank you for asking me about this. So I'm not quitting my day jobs with board advisory work, but my passion, you don't make any money and I don't do it to make money, but my passion is really writing these children's books. My first one came out in 2006. I use rhyming verse, picture books. I got the idea when my own children were small, and my husband and I every night would read picture books to them. And at the same time, I was a senior official at the Treasury Department, starting up an Office of Financial Education, and very concerned about, lack of financial education or financial acumen with a lot of folks. So I thought, well, picture books are a great way to teach basics. It's not intimidating. You got pictures, you can have rhyming verse. It's fun. And then it's kind of a stealth way to provide financial education to parents too, because parents read, or other grown-ups in the household, they read those books with kids. Mm-hmm. And I try to, as a former regulator, so I try to emphasize common mistakes, and in a fun, frolicking way, but to kind of show young children culturally how they can be taken advantage of. That we all have problems with impulse control. We all want immediate gratification. We're all tempted by get rich quick schemes or easy, to make money schemes, and that's the bad guys in financial services prey on that. So my more recent books, I've got a usurious lender, I've got a Ponzi scammer, I've got a flim-flam aluminum siding salesman who offers the princess a very bad mortgage to finance her tin siding and loses her castle while her dad's away. So those are the kinds of books I write now. I've got 2 coming out in the fall. One's about speculation called Daisy Bubble. It's kind of a riff on the tulip bubble, but it's about a lot of my books take place on the Galapagos, and there's a frenzy around daisy bubbles, Floriana daisies. And then the other is called Money Wizards. Some of my other books take place on the ice moon of Ganymede. So a moon of Jupiter, excuse me. And it's about inflation, as the name sounds. It's about a princess who wants to go on an expensive vacation, and her friends can't go with her, so she tells her money wizards to print a lot of money for everybody so they have more. And of course, predictably, a lot of money goes into the economy, and the supply is still the same, and that's what you get: price inflation.
Wow, that's incredible. That's so cool.
Yeah, they're a lot of fun. And thank you for asking me. I do care a lot about them. And
yeah. No, I can tell you light up when you talk about it.
Yeah. Well, awesome. It's, financial basics are not hard. Some people say, that's too young for kids. It's really not. They get it. I do a lot of school readings. They can understand the basics. And I think a problem with a lot of the current financial education, it is so complicated and convoluted. It makes your eyes glaze over. And it really is just about basics, regular saving, comparison shopping, don't do impulse buying, don't borrow for things that aren't going to, other than for a college education or house, something that might actually help you build wealth. Otherwise, don't borrow. And, avoid debt. There's such relentless pressure on us to buy and borrow to do it. And it's really created this culture, this debt culture that I think kids are just surrounded with and exposed to at a very early age. So in my own little way, I'm trying to counter that with them.
Yeah, no, and that's like a perfect age to begin talking to them because they can understand it, right?
They get money early.
Totally. Yes. It's all around us all the time. Yeah. That's amazing. Well, thank you so much for the time today, Sheila. It's been a pleasure talking to you and really appreciate it.
I enjoyed it, Kyla. Okay, Thanks. Great. You take care.
Great.
Thanks.
Bye.
Bye-bye then.